Okay, so we're here to take a look at Fidelity.com. We have managed to save up $840 or so. I hope you did better than that, and if not, let's keep on trying. What the plan is now is to invest this money and to start it growing and accumulating interest and profit through the market. Realistically, we're looking for something between 5 and 7% gains, and hopefully more if we get lucky, but we don't want to really go too risky to get that. What I would say is risky would be going into an individual stock, and the other problem with going into individual stocks is that each time you do that, you're going to pay a fee to enter and a fee to exit, and the fees per trade with Fidelity are $7.95 each way. So if I was to buy from $800 maybe 4 or 5 different stocks, that would immediately take out about $40 worth of fees, which is about 5% on the way in, 5% on the way out. We need to get 10% gain in profit in order just to break even. So that would be like a really dumb way to start off our savings and investments. Quite luckily though, they do have something with investment products here on Fidelity that's going to help us out. Under ETFs, iShares ETFs. Now these iShares ETFs are fee free, and that means that they allow us to enter the positions without a trade fee. It doesn't mean that they don't have management expense fees, and they kind of keep that on the quiet, but it's even that's a little bit deceptive perhaps. It's to be expected for these types of products, and it's very much industry standard, so it's not that much of a big deal. There's a lot of options between these 65 iShares ETFs. They're giving you a quick snapshot of where they break down domestic equity here from S&P 500. They also have international equity. You can take a total stock, international stock market. You could go for emerging markets in Europe or in Latin America. You could, for example, just pick somewhere like Japan as a specific country. Or if you hate Japan for some reason as an investment, you can say everywhere apart from Japan as all country Asia ex-Japan index. Also lots of options on a fixed income side. This would probably be good if we were trying to do more asset sort of retention. I would say I'm not a big fixed income guy right now. I know that other people are, and they like them, but I'm kind of concerned by lack of returns and other things, but we won't go into that too much right now. There's also commodity options. What we want to do is start to screen through what we have as an option and find what we have for you. And this is the point where you can see just how many options there are in terms of different funds. Each fund, these ETFs contain an entire index. Some of them, one of them will contain the entire US stock market. This ITOT. It's trades at $76.73 today, and if you were to buy one of those, you could enter it for that much. It would cost $76, and you just bought the entire stock market. So if that was to go up, stock market was to go up by from where it is now in 15,000 to 16,000 or something, you'd see a direct correlation to the raise there by percentages in your investment. So you have lots of options. What I suggest you do is you start doing screening in 2 ways. One is, first of all, if you have other investments, if you have a retirement account already, or if you have a brokerage account already, I would say take a quick look at something like Personal Capital. I've been pushing them a lot recently because I kind of like them in their screening product. I think they're very good at screening your existing products to see how much you're paying on a fund. They offer solutions for alternative funds with lower cost fees. And they also show you where your gaps are if you're overexposed between different accounts into specific sectors or underexposed everywhere else. When I did it, it showed me I was underexposed in 2 or 3 sectors, and one of them was actually in the REIT sector. I'll get back to that in just a sec. So I know I'm looking for REITs, but for you, if you're not looking for a specific gap, then you can start looking at where do you pick and how do you pick. And this screener starts off with lots of things that are kind of not important, if you ask me. You don't really need to know that they're iShares and they trade for free, because that's a given based on the fact that we looked at the 65 iShares ETFs. What would be useful would be to select criteria and look at net expense ratio. This is the annual management fee. So this will, if you were to buy your shares here and your funds here, you'll be paying this much money for them, and they range from 0.92% here downwards there's actually, obviously this goes on for several pages, the lowest one is 0.07%, and that would be for the total market, the total US stock market, ITOT, that we talked about just a second ago. This one here at 0.92, it's just because it's a different fund, it's a different location, and you'll find that once you get a little bit more exotic in terms of where they are, in terms of physical location, and also what sort of things they're trading in, you'll see fund prices increase in terms of expense ratios. India, to deal with India from a US perspective as a brokerage house, would probably cost a little bit more in terms of trade fees and management fees, so we need people who are specifically expert in this area in terms of human resources. And I think on top of all those actual real costs, I think they then slip in a little bit extra profit for themselves for their trouble. So if you do want a piece of India, then they're going to charge you a little bit more for the action. So you can go from here, and most expensive, to India, which is and probably all of these top most expensive ones you'll see are different foreign countries. India, frontier countries, microcaps. Well, it's a little different, but you have BRIC countries, which is Brazil, Russia, India, and China. Everywhere in Asia apart from Japan, China, Europe, all emerging markets. Flip it around, cheapest ones are closest to home and cover the broadest market. The cheapest one you could have, ITOT, at 0.07%. If you were to put your money in there, you'd probably be doing quite well. If the stock market continues to go up, you're going to go up with it. It's going to track the market in full. And if that's for you, then great. I would suggest it as a good starting point for pretty much everybody. For this routine, for this $5,000 challenge, I wouldn't say you necessarily had to be split between stocks and bonds initially. I would just go for the stock market first of all if you don't have any other investments. For me, and you are more than welcome to join me with this choice, is I would rather go for the real estate investment trust, as I mentioned, the REIT fund. This is it here. See if we can bring it up. Alrighty. So the reason I like this primarily is there's two reasons. I like it because personal capital tells me I don't have enough exposure here. I have enough exposure in other places, and if I want to get some more alpha or profit from my portfolio, I need to diversify into specific sectors, and a REIT would be a specific sector. REITs are good for certain reasons, and the primary reason for me, the main draw of a REIT, is that they pay off dividends. It's part of their, for them to be classified as a real estate investment trust, which is beneficial for them in terms of taxation. They have to pay out, I think, 90% or so of their annual profits in dividends to their shareholders. So they're always paying out large dividends. Now, the problem with REITs, the flip side of that, is that they are involved very deeply with a lot of different factors, primarily interest rates. And if you take a look here, you'll see what's happened to the market in general, because this IYR real estate ETF is a mix. It's 96 different companies in it. So you see a broad spectrum of what's happened to the market. You'll see that it has risen, which is great and what we expect, and then it's suddenly crashed down. And the reason that is because there's fear in the market right now that interest rates are going to rise. It's not really fear, it's very valid. It's very likely to happen that interest rates will rise. They're very low in general right now, and the way the economy is going, we're going to see them going one direction in the future, which is going to be upwards. Now, when they do, it is thought that lending from banks will cost more for these guys that are involved in mortgages for companies, and in that case, their profit margin will be hit. So if they're getting a mortgage for a new building in the city, and they're going to then subsequently rent it out for office space or for maybe residential even space, they'll be taking more of a hit on the profit side because they can't get money so cheap to borrow. So what you're seeing, I think, is an overreaction with that. Is that you going up, the fear hits because there's a little bit of news at this time that the Fed was recently talking about quantitative easing and interest rates. You see a massive drop down, and I think it's over excessive. What I find a lot of the time is when prices drop like this, it's because of knee-jerk reactions. It's because of automatic trading. There's people maybe that say when it hits 70, sell, so then it goes down again, and that's to protect like a stop loss order. And there's people then just kind of follow the crowd. And I think when it's going down, it's oversold and it's going to go back up again. So I'm in. I like it. And despite a lot of the things I preach about, being very spread out across the sectors, this works for me because I do have a little bit of an index investor at heart in the way I trade. And also, as I said, I did check in with my current base of portfolio, and I have a lot of exposure to the markets in general, so it's okay for me to be a little bit more risky and take this on. So that's why I selected. This is why I picked IYR as my iShares US real estate investment, and I went in for the full amount. I got 12 shares of it, and it cost me $821, and that's all from cash back. So thanks so much, guys, and look forward to hoping to see some similar sort of trades from you too. If you have any questions so far, let me know.